All right, it's good to be back after a week off. In fact, coming back to 20-degree weather here with snow on the ground in Utah, coming from a week where it was 96 degrees and sunny on our cruise. But back to be good to be back to our normal routine. Good to come back to a market that's hitting all-time highs, which is not very normal whenever I'm gone. So I'm going to break down this breakout that we've had today and what it means and what it means for what we've been expecting and now what can we expect going forward, considering how bullish this is and what are some areas and how broad this rally is and what are some areas that would take advantage of this breakout and how can we trade that. So I'm going to break all that down in today's trade and today's video. So let's go ahead and get started. Today is Monday, October the 28th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 on the market forecast indicator. And we can see that we have a strong bullish posture. It has been this whole week that I've been gone. We've had a nice, strong bullish posture. Dark green shading. We have a green line, a green line, which means we're above a rising moving average. And we have rising market sentiment. Market sentiment here in the orange is rising. So that's the and it's above 50. So you have about as bullish of a combination as you could possibly get. The near-term line pulled back right at the pretty darn close to expiration, well, the day of expiration, right before I left. Pulled back down and it got to 50 and a half. It didn't get below 50. So we've been now above 50 for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days, including today's breakout move to new all-time highs. It's a good, strong near-term run that you would expect to lead a new intermediate rally. When you have an intermediate trend that's just starting, your first ones tend to be. You can see this one was a nice long intermediate run. This one was, for the most part, you had a brief dip right there, but for the most part, you had a pretty decent near-term run that started that intermediate rally. And there's that near-term run, the first one, and then there's this first one. So a good, strong run so far to lead this intermediate run. In fact, if you look at the 5-year chart, you can see dark green shading, green line. In fact, you briefly had pink and yellow, which is bullish. Generally speaking, you can see it over here too. That's a pretty bullish pattern when you're on bullish trends. And we've bounced off of that, and we've continued to show bullish. In fact, the near-term line even pulled back here since, and it's bounced back up and back into the upper reversal zone and making its way back to the upside. So, we have this good, strong, bullish pattern here. If you look at the Russell 2000, not as strong yet. So we don't have the green line on the Russell 2000. It's a yellow line still. It's still falling. That's why it's yellow. If you look at its weekly chart, we do finally have dark green shading for the first time, and it's also still a yellow line there. So the Russell's still lagging, and we need the Russell to not be lagging for us to be really confident about this bullishness. But you can see if you look over here on the left, the growth stocks did well, and Russell was doing well for most of the day. There's MDY, the mid-cap stocks, and there's your Russell 2000. Russell 2000, you can see actually when you look at the daily chart, was up on the day. For some odd reason, it's showing flat now. If I look at IWM, you can see, nope, not that one. IWM here, you can see the returns it had. In fact, if I change this to IWM, change the SPX, keep it the same to SPY, you can see the IWM small cap stocks did lead the way higher, even on the day where the VIX was up a smidgen. So we had a good day. It's a broad-based rally today, which is a good sign, and you'll see even how much more broader it was here later in the video. But that's a good sign for the markets to see it. To see small caps participating today, but we need more of a catch-up for it to catch back up and show the same bullish patterns that you're seeing on the S&P, specifically getting back up to new 52-week highs. Now, the 52-week highs won't be all-time highs because you can see, we've been, this high point from last September we're still well below that. So it's still got to break out of this sideways channel before you can feel really confident about a strong, broad rally. But one day so far so good on the Russell 2000. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right there, and hit the red subscribe button that pops out. There's also one down below the video. That will notify you when these videos are posted. Also, click the thumbs up icon down there. That tells us that you like the video, that you want us to do it again tomorrow. It's a quick way to give us feedback you can do right now while you're watching. And comment down at the bottom. Comment on what you got out of the video today. Always appreciate to see or hear and see what you're getting out of our videos. Join our website at marketscholars.com for free. There's a link popping out up there in the top right corner of your screen that will take you to our subscribe page. You get access to our market commentary blog. You get access to our Market Outlook forum as well. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook community that we've created. All right. Also, we invite you to engage with us on social media here. We have the Market Outlook tweet and Facebook posts linked right here below the video if you're watching this on our blog. Just click this heart that opens up this new window. You can like it from there. Click on this image. It takes you to the Facebook Market Outlook Facebook post, and you can like it there as well. Again, the more you engage with us on these platforms, the more they will promote our content to you. And promote it to the top of your timelines so that to make sure you always get our content. So they will only show you the content you engage with, and so we try to make that really easy for you. Also, you can see our class schedule over here on the right. I'll be back. This is my first class back here, my directional option strategies. I remember there's 8 of these that we do, and then we have two Q&A sessions, but all 8 of these classes are available for our monthly plus subscribers, including as well as our daily Market Outlook Live, which I was back to doing today as well, which includes in that video doing the trade idea before the market closes. All right, if you go back to the charts, you can see the weekly charts looking really, the Heikin-Ashi candles are really bullish. We've already are above, in just one day, we're already above last week's high point. It's a very, very bullish weekly candle from a Heikin-Ashi standpoint. You can see the PPO is at 3% here. That means that the gap between in this case the 10 and 40 week exponential moving averages is 3% of the 200 of the 40 week moving average, related to that 40 week moving average. And you can see that that's pretty high. That's pretty bullish, but it's been more bullish, right? It's been all of 2017 and a good chunk of the first of 2018 above that level. So it's not like it's too bullish at these points. So good, strong, positive momentum, good bullish weekly candles. Again, you expect expect 1 to 3 month intermediate runs. That's 4 to 13 weeks. We've been progressively getting smaller runs, but we've also been getting progressively smaller intermediate pullbacks as well. Would suggest that we might be breaking out here to the upside and getting another pretty decent, decently long, potentially up to pretty much the end of the year in terms of weekly candles to the upside. If we take a look at the 3 green arrows, here, let's look at the 3 green arrow charts here. And here, let's just zoom in on the S&P 500 and give us just a little bit of perspective here. You can see that even the MACD is turned up higher. So we got 3 green arrows, green line, MACD histogram is turning up. Also, it's turning up on the 1226. You can see on the 1226, it's turned to light green again, means that we're gaining momentum. We are pretty decent distance away from the 12-day moving average, and for that matter, the 26-day. So in the near term, considering the near-term rally has been 13 days long, don't be surprised in the near term if we don't get a little bit of a pullback. If I were to change this MACD to compare the current price here to that 12-day moving average in terms of how far away we are above that, we are a pretty decent distance. Now, we've been stronger. Like, this is where we are right now. You look in the past, we've been stronger than this, but you notice we don't stay above here for very long. You can see peaks all along the way here that get up above it and then come right back down towards it. So, again, any near-term pullback, we would only expect it to be 1 to 3 days anyway, and it might not get all the way back down to the 12-day for that matter. Again, you look at that, compare to the 26-day moving average here, how far the distance we are away, and you can see very similar. We can stay above the 26 were a little bit longer, as you can see back in the past here. So decently strong trend that we have going on. You can also see it in the Bollinger Bands for the S&P 500. We are back up above. Here's where we are. We can barely see us here, but we are back up above. You can barely see the candle right there. So that means we're back up above the value area. If I go back to the 1-year value area, we're breaking back out into very low volume areas, obviously, because it's all-time highs. And you know, so there's been a lot of chatter about the volume being really light. Well, remember, volume tends to be pretty light because it doesn't need a lot of volume when there's very little volume resistance to the upside. Obviously, you need some volume to clear through some of these areas, and we've had it, and now we don't need it anymore. In fact, if you look at the volume here on the back to the 3 green arrow chart here, and we'll pull up SPY, and you can see that the volume was about 42 million shares trading hands. The average range was less than a point, but keep in mind the gap. So when you look at yesterday's close at 301.60 and then today's low at 302.91, so more than a point, about 1.25 points of gap. So that puts us about less than 2.25 points, not as minimal, but still below average on the ATR, and that's also well below the 1% mark. In fact, if you look at the volume here is well below the average, bringing the average down. The ATR, you know, again, 2.25 points roughly. In reality, when you include the overnight trading, that's going to continue to bring it down. We are below 1% mark. The ATR is below the 1% mark, so that means we're entrenched in this bullish trend here. When you look at the volatility, maybe we can see really quickly. Let's take a look at the 4-week range. You can see the gap. So again, near-term pullbacks. Watch to see if we might fill in that gap there to the downside. You can see we filled it in over here on last Thursday. Wouldn't be surprised if we don't get a little dip, right? Again, near-term pullbacks, considering how bullish we are right now, 1 to 3 days is a typical average. And considering we've had 13 days of upside, don't be surprised if we don't fill that in briefly before continuing on to the upside. Obviously, we're above the point of control. We are above the value area as well, which is where we'd pull back down to if we were to pull back. So we've got, you know, we're less than 10 point range. So 15 points would be that 5% mark where it kind of gets a little too high to the upside. Not anywhere near that as well. And the low is going to start creeping up too, because the low is all the way over here, which is good. You want the high all the way to the right. You want the low all the way to the left. The more that's the case, and that's what the Arun indicator shares here. Here's the Arun indicator. And here, the over 20 days, I mean, that's about as bullish of a pattern as you can get. This means that the high is all the way over to the right, and this means that the low is almost all the way over to the left. The more these two are separated, that's a very, very bullish pattern. Now let's go look at the volatility index. And you can see volatility up a little bit here today, but it's really, really low. It's flirting with extreme lows on the hourly chart. You can see how low we close on Friday. In fact, if you take a look at the weekly for this, that's the lowest close on a relative basis that we've had. You know, even if not on an absolute basis, it was the lowest close on a relative basis that we've had since last 2018. You know, again, getting that low, getting into the lower half of the chart is a very good sign. Again, might lead to some near-term weakness, but to be back to where we get an intermediate pullback again, we need to at least get back up above 90%. I'm obviously not anywhere close to that happening. All right, so before we move on to the next portion of our video, just to summarize our technical outlook, you know, we have a strong bullish posture. We are full bore ahead. We've had a good run during this week that I've been gone. We've had a good run with the intermediate posture, with the near-term run. We might be a little bit extended in the near-term run, but I'm talking about a little bit extended. We are definitely not, you know, I'm definitely not expecting an intermediate pullback anytime soon. But don't be surprised, especially with the gap that we had today, that we don't get a little near-term pullback. Again, 1 to 3 days at most, bringing the near-term line down below 50, and then starting a new 7 to 12 day run. And considering that the intermediate line is just starting, we've got 3 bullish candles in the weekly Hakinashis. The typical trend's 4 to 13, and this one probably, considering that we've been kind of coiling here, this one could be breaking out to one of those more longer extended runs. Considering the seasonality too, that's another reason to expect a more extended run towards the end of the year. We could be bullish here for a while, get some good near-term runs going here. So what do you think? Do you agree with that assessment? Do you disagree? Click that link that's popping out at the top right corner of your screen, opens up a poll, and you can vote. Either agree or disagree. If you click disagree, comment down below on what you're seeing that would suggest something different than what we just came up with here. All right, now let's transition over into what's driving the price action. So let's take a look at the asset classes and how they're doing. In fact, let's take a look first here at the weekly chart. So let's customize this, or at least since I've been gone, just to kind of summarize that, and then we'll just look at today. Oops, I won't go that far. There we go, and then we'll go to this 21st. That includes the gap, any gaps that we might have at the beginning. We'll go to about a 15-minute chart. All right. So you can see last week crude oil had a really, really good week. Small cap stocks also had a really good week, along with emerging markets. So very positive from that standpoint. You can see gold did okay, despite even some strength in the dollar and despite some strength in risk appetite. On the other end of the spectrum, you can see long-term bonds falling, which means, and especially happening today, but which means that people are coming out of these safety trades that were so overextended to the upside. Again, the market causes the most pain, and the most pain has been a very pessimistic, a very heavy bias towards safety trades, and it appears some of that's coming off. Now today, not so much. So if I just zoom in on just today, go back to a 10-minute chart, you can see, small caps, emerging markets, all these equities, all up. Not very much, but up. And crude oil weighing on some of those gains because crude oil was down 1.5%. You can see gold down, but so was the dollar, gold, and long-term bonds. So you can see how that safety trade really unwinding. In fact, if we take a look at the kind of long-term chart of TNX, you can see now we are filling in the gap between the 50 and 200-day moving averages. You would expect now that we'll probably make a run. We got to get above this 23% level, but we expect now we'll probably make a run up towards this 38% level, towards 2.13, and potentially up a little bit above the 200-day moving average. So that's a level. That's definitely something to keep an eye on. The dollar, you would expect to move up along with it. It's been pulling back. It's had a big drop the last few weeks to the 200-day moving average. It's held. You can see we're trying to get a little bit of a transition candle going here this week on the dollar. If I take a look at the market forecast for the dollar index, you can see the big drop that we've had, the Harami pattern that we had coming out of the expiration when I was gone here last week, and then the multiple cluster of clusters, and then bouncing back up. Now we're back to a weak bullish posture. Now the question is, are we going to get back through? We've kind of held support at the 62% Fibonacci retracement with this bullish reversal pattern. We're back into the midpoint of this retracement level. We're going to get back through the 38% and beyond, right? We won't be bullish again until we break through this 23% level, which would be up in this area. So you'd have to get back above 98.75 before you consider yourself bullish, but the pullback would be done if we were to get back above 98.25. So those are some key levels to watch. This is obviously today's move, and this is today's move, and this is what's going on so far in the new period. But a good bullish move towards the top end here will kind of nullify some of this weakness that the dollar has had, and you would expect the dollar to be bullish going in, and especially with weakness, with strength in yields and weakness in gold. You can see how gold's been kind of flatlining. If the dollar's going to be bullish, you'd expect to break down here in gold prices. If I were to go back to a weekly chart for gold, you can see how it's kind of flirting. It's got this big gap up here, flirting with that 50-day moving average. Again, once you break through, we get down to the 200-day pretty darn quickly. The other thing to keep an eye on with the strength in the dollar is crude oil. But crude oil, the thing about this is, like the Russell 2000, you kind of need a breakout here to kind of support and confirm this strength in the risk trade, right? So that wasn't the case today. We'll see, how this plays out. Whether it gets back above the 200-day moving average, at least turns dark green again. If you look at the market forecast indicator for crude oil, and you see you got a bullish posture. You've had the near-term pullback. Now the question is, are we going to bounce off of this near-term pullback and re-engage some strength and get back to the point we had dark green shading and a green line, right? Obviously right now would be a yellow line, and depending upon how bullish we end up today, might turn it green, but most likely we'll at least keep it yellow until you get those dark green shading, get the dark green shading on the intermediate posture here. Now, if we take a look at the foreign markets, when I talked about how broad this rally is, if we take a look at these charts here, look at that. Dark green shading across the board, and that has not always been the case. When the U.S. markets have been strong, it's generally been weak everywhere else. But look at that. Dark green shading, green lines everywhere. In fact, we're even getting overbought clusters in Japan. That's in Japan and South Korea for that matter. That's how bullish we are. So very, very good trends globally. The only place that's really not participating yet is India, because we have a falling intermediate line, and so it's lagging a little bit, and it's dropped so much. But everywhere else you got, and in Canada a little lag too, but everywhere else has been really, really bullish, and that's another good sign. Another sign that this is more than just a little bounce. That this intermediate run definitely has some legs to it because of everybody that's participating. Another sign that it's in terms of the pain trade of causing the most pain. You can see markets were well positioned over the last 3 months into these safety trade sectors, including to some degree staples, but mostly real estate and utilities. You can see those are the two weakest performers, along with staples. Energy is still struggling. So it's hard. It's getting harder for it to get a grasp. But you can see, look at the move technology has made. So if I were to take a look at, let's just take a look quickly at how it did here just today alone. Go to October. Then go to 10 minutes here, and you can see technology, healthcare, communication services, all these are your FANG stocks that are included with technology. Those are what you want to lead. Healthcare not so much, but at least those two are what you want to lead the way higher. Look at financials doing well relative to the S&P. On the other hand, your safe havens down here, and that's kind of typical too because of how bullish they were. Normally when you're bullish, they will lag, but they don't necessarily drop, but they've been so bullish, that's kind of why they're doing what they're doing. When you look at the 12 grid chart, you can see, again, dark green shading across the board here. We don't have some green lines yet in industrials. It's, that's a key trade sector, similar to materials. Energy and materials still struggling with the strength in the dollar. And if the dollar continues to be strong, I know we've had its pullback, but if it were to bounce back up, these are going to lag. They might be bullish, but they're going to lag. But look at utilities dropping, look at real estate dropping, staples struggling to some degree to get up to new highs, whereas healthcare is up to 3-month highs, financials has an overbought clusters, technology 3-month highs, discretionary is kind of lagging behind. A lot of that's Amazon, but discretionary is lagging behind there. Here's your FANG stocks, lagging a little bit too. We don't quite have the green line. You have dark green shading, but you don't have green lines in communication services or industrials, because some of these cyclical areas. We don't have dark green shading or a green line in communication services. So you can kind of see, as bullish as we are, and this breakout that we have been, it's kind of mostly been driven by technology here and healthcare to some degree. We don't have a whole lot of strength in these others. So it kind of shows how much more potential there is if some of these other cyclical areas really get going, similar to the chart, the pattern that we see in the technology sector. Now, as I take a look at our trade idea of the day, I do want to remind you that we've already put this trade on in our Market Outlook live video. The link to attend is also, if you mouse over the trading rooms link, there's a link right there to attend the Market Outlook live. So we've already put the trade on for the day. And also, if you want to see how these trades work all the way to their close, we manage those trades every day. At least every day I do these videos in the Market Outlook live. So remember, that's access, both your plus and premium subscribers have access to those videos. So if that interests you, that's how you get access to it. But let's take a look at our trade today. Caterpillar is the one I wanted to look at. We've had a trade going in Deere that's worked really well that we're pretty much done with, but you can see Caterpillar is trying to, it on an intraday basis broke out to a new all-time high and actually probably closed at a new, at least a new 52-week high, not all-time high, but a new 52-week high as well. Strong bullish pattern here on its daily chart. In fact, on the weekly chart, you can see dark green shading. Intermediate lines just barely starting to get above 80 with strong and near-term posture, and you've got the green line. Now it's, depending upon how any kind of short-term pullback we might get, that line looks like it will turn green here pretty quickly. So it's got a good pattern developing. You can see on a long-term chart, Caterpillar is just barely getting a golden cross where the 10-week moving average or 10-week exponential moving average or 50 days is crossing up above the 40-week or 200-day moving averages. After this long consolidation towards Fibonacci support here, looking like we're breaking back up above the 38% retracement line and back up towards these highs and breaking through it, again, depending upon how you draw this line, breaking through trend line resistance that we have coming across these highs. So good, strong pattern developing on Caterpillar. Here's the 3 green arrow chart and what it looks like. You can see good, 3 green arrows on a 2-line basis. This is what it looks like on a 2-line chart. We are 8. All 3 lines are rising. 8's above the 17. 8 and 17 are both above the 30. The orange line's bullish, strong bullish momentum, strong bullish. Buyers are in control according to Stochastic. Strong volume coming out of this earnings announcement. If you take a look at its Bollinger Bands chart here, you can see that we are breaking out of the not only above the value, the point of control, but out of the value area into low volume resistance. Very good sign as well for the stock. If you take a look at the DMI for Caterpillar, you can see well up above 30. On the DMI, getting up to 40, and then the negative directional index well below 20. So good, strong trend according to the ADX. If you look at the trend strength indicator for Caterpillar, you can see we're getting to the point where we're developing a strong trend here too. And once you get up to that point, you can have a strong. In this case, we were bearish, but you can have a strong trend for a while. This is the first strong trend we've had to the bullish side for quite a while. In fact, you have to go back, a couple of years to see the last time we've had a really good, strong bullish trend to the upside. And again, kind of shows just how strong our trend is right now and what it could be. So lots of potential. Here's the weekly chart that's just barely starting a new bullish trend. You can see lots of false starts here. But considering the breakout, considering you're getting above the cloud on the weekly chart for the first time, there's opportunity for a good long-term trending trade move. So in this case, I went out to February instead of doing a kind of a short-term directional trade. Say with the December contract, we've gone out further, bought at the money, put our stop order at 50%. So you right-click here, buy custom with stop, and put your stop order at 50%. Of that. So if you take a look at Caterpillar here, let's go to this is a single symbol here. You can see that the risk here is $1,650. So 50% stop order would cut our risk in half. So a little bit less than the 1% that we typically have been using for these trades. With the potential, 1 standard deviation move of getting towards 160. By February expiration. Sorry. 1 standard deviation move getting up towards 160. Yeah, exactly. And then, again, 2 standard deviations would get us close to 190. So 1 plus standard deviation would be in this area for $800 of risk. We can get up to from $2,600 plus up to $5,000, depending upon how much it moves. So pretty good reward to risk ratio on a stock that may be trending upwards now because of this kind of long-term consolidation pattern that we're breaking out of back to the upside. So if we get a little near-term pullback and this stock pulls back with it, no big deal, because of the it will take to get stopped out, and we'd have to come all the way down to around this area to 130. So of course that would mean that we'd have to break back down below the cloud, back below the 38% Fibonacci retracement, and basically nullify this breakout that we've just had. All right, and that wraps us up for today. As always, you've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen that goes to our Market Outlook forums. Remember, that's one of the things you get access to as for being a free subscriber to our site. But open up any new threads with questions or comments about anything I talked about in the video today, or for that matter, anything I didn't talk about today. And I'll be, let's keep this conversation going in between videos. As always, thanks again for watching. Remember to hit that thumbs up icon, comment on the video, subscribe to our YouTube channel, follow me on Twitter for more content in between the videos, and join our website at marketscholars.com, as well as the Facebook group that we've created for the Market Outlook video. Have a great rest of your evening, everybody, and we'll see you all next time.